So where are we 12 months later?
We had a decade of price appreciation happen in like a year and a half. I don't know how long we'll be here. We rarely stay in these situations very long. This is a good place.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back to the show. Brendon Ogmundson has joined us for the three-peat. He agreed to come back a third time. He's the chief economist with the BCREA. Brendon, welcome back.
Great to be here. Thanks.
Now, I want to ask you personally. We know economists are still a little bit of a celebrity thing these days. People really are excited about what they have to say. How have you found 2024? I think I asked you something similar last year, but this year compared to how long you've been doing this with everything going on, how have you found it just personally and in your work life?
Oh boy. Anytime you've got a year like this, when you've got, the Bank of Canada's cutting rates, and we've got especially now since events transpired in the first week of November, which has been like keeping economists busy full time. When I forgot how fun it was to respond to major policy proposals that are made via all caps fringe social media rant at like 7 get right, and it's like, oh, okay, I guess I'll have to talk about that tomorrow. I forgot how great that was. So anyway, the year has been really interesting. Going to get much more interesting over the next year. I'm expecting to be very, very, very busy.
We got to give you a lot of credit because you were on our show end of 2023. And I remember we were asking you about Bank of Canada and what they were going to do. And you had said, like, with full certainty, like, oh, they're going down at least a point. And if you like go back to that episode and you like pause it at me and Steve's faces, we were just quiet. We're like, are you sure? And not only have they done that, but they've gone, further than that. Now that you've seen what they've done so far, and this episode will be out a few days before the next announcement in December. Thoughts just on what they've done so far based on what you thought they were going to do?
Yeah, it's because the economy has sort of evolved and inflation has evolved the way our models expected, and I guess they're pretty similar to what the Bank of Canada's models were expecting. It's not super surprising that they've taken the path they have. And in fact, because inflation's been a little bit lower than they were forecasting, so their July forecast for inflation in the third and fourth quarter was that it would still be around 2.5%, and instead came in, I think, in September at 1.6 and in October at 2. So well below what they had thought was going to happen, at least in their July forecast. I think that's probably why they cut by 50 basis points in October, was simply the way monetary policy kind of works is you have a model, you make a forecast based on a rate path that they set. And then as data comes in, so as inflation data comes in, GDP data comes in, kind of benchmark that against your projections. Are we close to forecast? Is the economy evolving the way we thought? And at least, based on their July forecast, it wasn't. Right. Inflation was a lot lower, which meant that rates were too high. And I think that's why they did the 50 basis point cut. They didn't really tip their hand much about what motivated that cut. If you watch their press conference or read their statement, all they said was, to keep inflation close to 2% and to encourage economic growth, which is the entire mandate of the Bank of Canada. So right. It's not really boilerplate. It's not really saying anything. So it doesn't give you much of an idea whether or not they'll cut by 50 in December or not. But inflation's now right on their forecast. That probably means that we're maybe only getting a 25 basis point cut in December, but there's also lots of reasons why they might want to take out a bit of insurance on the next kind of the volatility of the next year. So we'll see. I think it doesn't really change though, like where they might end up. I think how fast they go isn't quite as important as where they stop. And I think where they're stopping is by 2.75 and maybe a bit lower, but I don't think that's changed much. That's kind of the midpoint of their neutral. I can see them stopping there and reassessing about, do they need to keep cutting or not?
So based on the announcements going into 2025, if we get one in December, one in January, and then two, like if we let's just say we get 4 more 25 pointers and get to that 275, do you think
Yeah.
when they stop and they say they're going to stop, well, I guess they won't technically say that. They'll say, well, we'll see what happens, because that's what they always say. Is that when
Yeah.
sales actually start picking up again? Because I've found, and we've talked about this on the show a lot recently, where when rates went up, prices dropped off significantly. Now that rates are
Yeah.
going down, prices certainly have not gone up significantly because everyone's still waiting for them to be done. Any thoughts on that?
Yeah, it's funny you give me credit for a good forecast. So this thing I'm doing in my presentations, I started start with, we got all the big four kind of themes right about the economy and rates this year. So, we thought there would be a soft land in the economy. That's happened. We didn't fall into a recession, and the growth has been slow. We thought inflation would hit its 2% target this year and not next year, as the bank had originally forecasted. We thought rates would come down, we thought mortgage rates would come down, but generally have trouble falling much under 4.5% on a 5-year fixed. And then we thought there would be a pretty strong second half recovery in home sales. And so we got all this right, and then didn't get the last thing right. So I've got it in my my slide deck on our housing forecast. I've got the classic Carlton from Fresh Prince taking a half court shot. He steals the ball from Will, throws the ball from half court, and misses the hoop by like 10 feet. So like that's our housing forecast this year, because we had baked in a second half recovery once the Bank of Canada started lowering rates, because that's what happened in 2023 when they paused.
Right.
If you recall, the Bank of Canada paused at the start of 2023. We had sales get back to, go from about 20% below average to kind of average in it was like April, May. And then they raised rates again in June and July. And that's when the market went right back down to about 25% below the 10-year average. Home prices started to soften. And so, we thought something similar might happen when they're actually cutting, where we get a real bounce. It just didn't happen. It didn't happen really in any market across Canada until October. So when you're asking about when is the market going to recover, it kind of suddenly did. September was again like 25% below normal in the Lower Mainland and in BC and in most markets, and then in October jumped to about 5% below 10-year average. So about a 30% increase year over year, about 15 to 20% increase month over month. So going from 25% below normal to basically normal is a pretty big move, and we're maintaining that level in November. So it seems like the recovery that we thought was going to happen a lot sooner has arrived. It just took much longer than anyone thought, and why everyone decided all at once, because this happened in Toronto as well. There was a pretty significant month.
We're up
uptick.
44% year over year in October.
Yeah. So obviously there's probably one common motivating factor across Canada. There's likely rates, maybe, people thinking, well, the Bank of Canada is really cutting down. Maybe prices are going up. I need to get in sooner. Maybe it's the people looking now, trying to get ahead of the changes in policy. So 30-year amortizations for first time home buyers and buyers of new homes, change in insured mortgage cap. Whatever it is, there seems to be something that's really motivated buyers to get back into the market at the end of the year, which is not the way things normally go, but I'll take it.
I'm gonna wait till a bit later on in the show to really dig into those. Steve,
No, that's a perfect.
You want to go
segue.
now? Okay.
I had some BC questions, but since we're talking federal and you mentioned them, we do want to know about what kind of the modeling that you guys are doing, what you think is going to be a result. Let's break them into two different sections, even though they're going to come in at the same time and kind of why change one thing at a time when you could change them all at the same time, right? Like that'll really tell us what the good effect was. So let's start off maybe
on next year, so we need something to do.
We need to fix it up, right? So let's talk $1.5 million CMHC cap. What effect do you think this will have? Is it another nothing promise that's nobody's going to take advantage of, or do you think this is something that's actually going to take a serious effect on the market?
It's tough to quantify in terms of like how many, extra sales will this kind of increase, whatever. Um, I think like maybe it's a bit more nuanced. I think there's this idea. Andrew Liss at the Vancouver Board has a great video about this, about the sort of $1 million wall, about your minimum down payment. So if you're looking at homes and at $999,000 on an average, for a priced home, $75,000 is the down payment. As soon as you go to $1 million, your down payment jumps from $75,000 to $200,000. So it's a huge increase. Talking to realtors around the province, a lot of them have clients that you're kind of, if you're, say you're younger, you're late 20s, early 30s, maybe you own an apartment, but you've only owned it for a couple of years, and you have the incomes to support a pretty large mortgage. You can qualify for putting 10% down on $1 million home, so you can qualify like a $900,000 mortgage because your incomes can support it. You can pass the stress test, but you don't have the equity or savings to put down $200,000. So you would like to move up from your apartment or your townhouse into a single detached home, and you can't because you just can't put together that large of a down payment. So I think there's a lot of those situations, and it kind of unsticks parts of the market. So it will have the benefit of encouraging people in that situation. In expensive markets, obviously, is where this will apply. We encourage them to move so they can finally upsize from their current situation, and then that frees up parts of the market that are maybe more affordable. So then it increases some listings of townhouses, apartments, whatever, maybe rental, but something. So they kind of just unsticks part of the market that's been, I think, kind of stuck because of policy that should have changed a while ago.
Are you worried about the potential level of debt? Like, I'm going to give you the extreme example here, which is probably never going to happen. But let's say I buy a house for $1.499999, and I put down the minimum of $124,999, and I qualify for this, and I take on a 1.375 mortgage. And let's just say I'm a first-time home buyer, so I also get a 30-year AM on it now. Like, we're just combining all these in here. That payment's probably $7,500 a month. Your household income to qualify would have to be like $350,000. Like, I get, I'm sensational. Let me try that again. I'm going to the extremes here.
You gave up. You gave up on even trying to pronounce
the third after twice. I give up.
Sensationalize.
Okay, we've got it now. Thank you. Sensationalize. There we go. Third time. It was just so wild in my head, I couldn't even get the words out. But like, is that not kind of concerning here, where it's like, I had someone comment to some of my social media stuff that was like, as harsh as it sounds, like you shouldn't even be allowed to buy property if you're not putting 20% down. Like, that's not enough skin in the game. That's worrying. That's so much debt. It's just going to increase the prices down the road. You can see where I'm going with this. Any concern on the amount of debt, even if you can qualify, it's like, just because you can maybe doesn't mean you should.
Sure. Yeah, I wrote an article about this. I think it's in Real Estate Monthly. Is that a thing? REM? Is that what that stands for?
Yeah. Andrew owns
REM.
Yeah.
We wrote an article. Obviously, you guys are avid readers. I wrote an article about this exact thing last month. So it's a trade-off. You have to kind of balance, like, there's a huge share of young people that have a lot of frustration about housing. And if this helps them, both of these policies, the minimum, the change in amortizations and the change in the mortgage cap, if this helps them get into more adequate housing, or helps their situation more, that we have to balance that off with against whatever very, very small increase in sort of the overall, like, say, like, vulnerability of the Canadian economy due to high debt to income. In the case that you're talking about, like, if our biggest worry is people with $300,000 household income taking on too much debt, like, no one really talks that way about leverage in certain, like, wealth stratas, right? Like, no one's like, oh, that's you're taking on too much debt. Most, like, if you have an income that high, I'm just going to assume you're
probably not
okay.
putting down the minimum anyways. So
not really my biggest worry. I don't think this is going to be something that's abused. You still have to pay at this, even on a say you just get $1 million or $1 million with 10% down, you still qualify on a $900,000 mortgage at a stress test rate too. It's not like,
Yeah, 6,
qualifying is
7%.
difficult. And that's the buffer. That's the buffer, right? So we've already accounted for like the default risk in a way. So I'm not worried. I think it's there's more benefits to helping young people afford housing, even if that means taking a little bit more debt and for a lower payment. I think there's a larger benefit to that than there is a cost to sort of add in a little bit of vulnerability or volatility through slightly higher debt take up.
CMHC and Sagen have to be jumping up and down at this, right? Like, I mean, it's going to be amazing for their business. And is there less concern because in all of these that they're insured mortgages?
Yep. Yeah, no. Yeah, so this is the, you have a lot of people who obviously think like, why should taxpayers kind of take on the default risk? And that's a philosophical argument. Like, yep. But this is the system we have in Canada. Like, we've decided that home ownership is an important thing, and the government is going to subsidize it. So there's there's this weird thing when we look at like mortgage rates. An insured mortgage rate, a 5-year fixed insured mortgage rate, is lower than an uninsured. Because there's a discount there because the government is backing it. So you're taking people who would otherwise be much riskier borrowers and allowing them to borrow at a lower rate and with a lower down payment, because we think that home ownership is a good thing.
Steve, where do you stand on this? I feel like you're not a huge fan of it because is it not just going to push up prices between $1 million and 1.5 eventually here if you allow more people to get in?
I think so. I am in that camp of, I would like people to have skin in the game if they're going to take on that much debt. But at the exact same time, I think on the other side of the coin, personally, I think the debt to income ratio that you see on the news of whatever it is, 185% or whatever, it's such a BS metric.
Your real estate website should work as hard as you do, and that's where Realty Ninja comes in to create a beautiful website that helps you convert online leads, that doesn't give you all these tech issues and will match with the brand that you already have. Steve's been using Realty Ninja for over 10 years, and we have a promo code for listeners of the Tom Storey Show. RealtyNinja.com/Tom will give you 20% off your first year, and you don't pay $1 until your website launches. RealtyNinja.com/Tom. And now, back to the podcast.
Kinda, right? Like, when are you ever going to pay off your house in a 1-year income, right? Like, it's not, it's a stupid.
It's comparing a stock to a flow, which is never a good idea. Generally, I should say never, but yeah, I prefer to look at debt to assets, which is much better. Like, how much you have the assets to cover this debt if you needed to. That's the way most people will look at these things, or debt to net worth, even. It's like something, right? But like, and those ratios look great in Canada. And it used to be, you would point out like debt to assets is really good. Even debt to non-real estate assets looks really good. I think in coverage for Canada, I can't remember, something like 2 or 3 times debt in terms of of non-real estate assets. Like, Canadians have accumulated a huge amount of wealth, and not just in real estate.
I'm going to get to the tariff questions in a bit here, but we'll wait a little bit. But I just want to ask this. You had said this previously. I think for the listeners, they're either going to very much agree or very much disagree, depending on where they stand. But this magical soft landing, did it happen? Did we really not get the recession we were waiting for? Because I know some people are like, damn, my life's harder. It's really expensive for me. I'm feeling it right now. And some people are doing great. So from an economist standpoint, did that soft landing truly happen, or is it too early to call that?
Yeah, so soft landing is not now everything's great, right? Soft landing is just like, we had a situation where inflation was much higher than target, and the Bank of Canada had to really tighten rates. That almost always results in a recession through history. This time it didn't. So we managed to avoid a recession while getting inflation back down to its target. That's sort of what we mean by a soft landing. Like, it didn't take a recession to bring down inflation. We're still left with the impacts of like the cumulative impacts of inflation. So when people think about, go to the grocery store, like, prices are still higher. Prices don't come down because wages don't come down, right? Like wages also went up a lot over the last few years. So, prices can't come down if wages are still at their levels that, they've also gone up significantly over the past few years. So, um, people are, I don't know, like we saw this in the election. We saw this in every election. People are just really upset about adding company governments. Like the MVP here in BC almost lost to a party that didn't really even exist
By
6
like
months
one
ago.
seat, right?
Right. Yeah. So people are really mad at incumbents because everyone's kind of really mad about the last 3 years. It was a really terrible few years. We had we were locked down because of a pandemic, and then we had really high inflation, and then there was the economy's been slowing down. The unemployment rate's up a bit. It's kind of cold comfort to say like, well, it's not up. The unemployment rate's not up as much as it could have been, or now inflation is back to 2%, so you should feel better, even though overall prices are up like 20%, right? So it's hard. Like as an economist, you're like, this is a great thing. Like this is like a unicorn situation. You don't really get soft landings to what we call like normies. So non-economists, it's like, what are you talking about? Like
General
everything is
pop is
worse.
what you call us.
Well, everything is worse, right?
Mudbloods.
And it's interesting. Like, even though like real wage growth is positive, like people are actually earning, outpacing their wages are outpacing inflation the last couple of years. Like, it seems like things should be getting better, but everyone's like wealth, at least if you're in a certain, part of the income distribution, your wealth has increased a lot. If you're a homeowner, your wealth has increased a lot. Um, but yeah, for whatever reason, people are still sort of, they're just upset generally. And sometimes this is like in Canada, this happens every 8 years. A government
Mhm.
wears out income, starts to look real stale. It happened with the Conservatives before, it's happened to the Liberals now. It happened with the Harper government that everyone loved. Suddenly everyone hated. Now it's happened with the Trudeau government that everyone loved, and now everyone hates. It'll happen with the next government after 8 years, and it'll just keep going because that's what we do in Canada.
Yeah.
We fall in love for 8 years, and then we absolutely hate the people we've put in power, and we switch it up, which is the way it's supposed to work.
We're like Oilers fans. We're just waiting for that next season to start so we can be hating life again slightly later on. Yeah. And then we go, well, at least we don't live in Edmonton.
I'm a Seattle Mariners fan, so I go through this every season. I get like my hopes up, and then people starts. I'm like, oh, I
You just
hate
have
this
to
team so
enjoy the
much.
ride. I'm a Leafs fan, so we're all just full of pain here. And you just got to enjoy the little wins you can get because the big one rarely ever happens.
So
Fair.
shortly, we're going to get into where we're headed. But I want to first talk about where we were and where we are now in BC, because that's where you specialize. That's what you focus on day to day. So last year when we met, we were still in a general listing deficit, right? Generally, we didn't have enough. I think the number was something like 30,000 listings across BC. And you said we needed to get to a spot of normalization around 45,000 or so. And then we would get into kind of a balanced market where everything could kind of chug along and we wouldn't feel the crazy pressures of upward pricing and just, unconditional offers and all the craziness that's going on out there. So where are we now? Where have we come 12 months later?
Yeah, I think I would say that a year ago, we were in what I would consider a bad equilibrium, so where markets were balanced. So we had basically flat prices, um, but at a really low level of sales and a really low level of listings. So I think in 2023, new listings in the Lower Mainland were the lowest they'd been in 20 years. Uh, we've come back to normal this year, so we have more new listings. Active listings are, I think, in the province at about close to 40,000. So around, in the range that we would consider like long run, kind of healthy for a balanced market. And now sales are getting back to long run levels as well. So this is like a good equilibrium. We've got average levels of sales, healthy level of inventory, and markets are kind of like in balance. So like in the Fraser Valley, prices are a little bit soft. They're coming down month over month a little bit, but have essentially been flat since early 2023, maybe even 2022. And other markets though are seeing kind of prices up 1%, up 1.5%, whatever. So kind of like a typical balanced market. And this is where we want to be. Lots of inventory, lots of choice for potential buyers, a decent amount of buying activity happening, so a lot of transactions, and prices that aren't, massively accelerating. This is a good place. I don't know how long we'll be here. We rarely stay in these situations very long. But this is kind of exactly where we would like to be, in, with, especially on the pricing side. Like, we had a decade of price appreciation happen in like a year and a half. Um, we're going to need a lot more. I would like it if prices just sort of, flat to up 1 or 2 a year would be great.
It has felt fairly flat in BC, and if anything, I feel like we kind of have a seasonal trend of pricing now. Like, it for the last 3 years, pricing has kind of trended with inventory, which I think is kind of a new phenomenon. But last year, I asked you, and I told you I was going to hold you to this, so I've written it down here. So you better not have this one wrong. Last year, I think the overall in 23, the overall average price across BC, I think you said was 960, 966, somewhere in there. And you guys had projected it up to almost a million at like 996 is where you were hoping to kind of end the year. Did you win that
Yeah.
one, or did you toss up an air ball there too?
Well, I don't think it was an air ball. I think it rimmed out. Um, I think I think in October the average price was 970. It's going to be higher in November, um, because this is the way, averages work. It was sort of artificially low for a bunch of months because expensive markets were much weaker. So even though prices weren't necessarily coming down, Vancouver was and Fraser Valley were a much lower share of sales than normal. So we could get the average price rising to, I'm guessing November, because of, Vancouver's and Fraser Valley have had pretty strong sales, and the average price in Vancouver for November is like closer to 1.3. It was 1.25 last month. Is going to put some upper pressure. So I bet we were pretty close. I bet it's going to be in November. The average price will be like in the 980s would be my guess. So didn't swish it, but it was close. Like, the other team was nervous at the buzzer for sure.
It bounced
So
a few times.
are you
Yeah.
seeing that kind of seasonal? Like, am I right to think that that's kind of a new thing where seasonal prices are becoming a
Yep.
thing?
Yeah. This wasn't a thing. I was sort of like, when I first started, my old boss, Cameron Muir, used to always say, like, there's not really any seasonality in prices. Like, there shouldn't be seasonality in prices because then you could kind of game markets. Um, um, but no, like, we're definitely seeing like more like peaks kind of in the spring, which is, you get a peak in sales, but usually like you get, the same like amount of inventory kind of also has that same cycle. So it shouldn't put extra pressure on prices. But yeah, we're seeing this like kind of like prices sort of peak in the spring. It's very soft over the summer, and then they have another little peak at the end of the year recently. I don't know if it's just a weird kind of one-off the last couple of years because we've had non-seasonal kind of patterns in sales because policy has sort of distorted our normal seasonal pattern a bit. But yeah, it is something that I've noticed.
Brendon, if I'm a first-time home buyer listening to this, and let's just say, like, mathematically, based on who's watching this or listening today, 30% or just slightly more don't own real estate, and another percentage of that group is in the zone of like they can qualify, they could buy, but they saw the craziness, they saw the drop down there, they've seen things kind of just do nothing for a while, and average price go up and down month, but kind of just hover here. Now they're seeing rates go down. We'll get to the fixed rate in a second here. Should they now feel that this is the safest? I've asked Steve this recently, but is this the safest it's been in a while to feel like, okay, I can enter the market? It's a balance out condition. It's not going to drop another 20% from here. How should they be feeling?
So yeah, I can answer this in a vacuum where we're not facing potentially ruinous economic policy.
Mhm.
So if
We'll get
you
to that
if
next.
you yeah, so without thinking about that, it is kind of a nice spot where, and we haven't. I don't think I've ever been here in my entire career, where everything is kind of approaching like, so like, I'll put it in this way, like when we have like models and everything kind of comes to a equilibrium over at the end of like 2 years. So, just the way mean reversion's baked into all these things. You get to this like sweet spot where inflation's at 2%, the economy is going to grow at its long run potential. Interest rates are at their neutral levels. That means whatever 2.5, 2.75 overnight rate, 4.5% 5-year fixed rate. And it's kind of everything's at its long run level. Home sales look like they're at their long run average. Active listings are at their long run average. Home price growth then should be kind of balanced, 2 to 4%. It's a good spot, right? It's like the least volatile it's been in a very long time. So yeah, if I was a first time home buyer, this is like the most sort of like placid sort of conditions there could be. Again, we don't ever stay there that long.
Right.
But yeah, like if I was looking like this is the least volatile, I think if you, again, in a vacuum, the least volatile things have been in some time.
Not to put words in your mouth, but I will. Knowing what you know now, taking you back to the age of you buying your first property, having the experience you have now, would you look at December, January, February as an opportunity if what you wanted existed to enter the market in this calmness before, who knows, maybe things do get worse, maybe they get really good, I don't know.
Yeah, my advice is always like for housing, just don't try to time the market. Like you're not going to be able to do it, and you're probably just going to miss out on things if you're trying to constantly time things. Things work out. I don't know. Like our first home we bought in Maple Ridge, so well outside of Vancouver, in 2006. It was all we could afford on a recently graduated grad student and part-time nurse salary with a baby. And then we sold it, made some money, bought a townhouse in Pitt Meadows, so not far away. At the absolute worst time, I think we paid peak prices in 2008, and then sold it at the bottom in 2012. So awesome timing. But
did you lose a lot of money? Did you lose?
Oh, I think we lost $30,000.
I guess percentage-wise, it doesn't hurt as much as now today's prices, right? Being
right.
So much.
Yeah. So that was buying a townhouse when you could still buy it at, I think we paid $380, sold it for like $350 or something. But then, we bought our house and that worked out great. So I don't know. Things are going to happen. Don't try to time it. Try to stay in a place long enough that you can kind of smooth out the volatility. So if you're going to buy a place, it'd be great to stay in it for 5 years and you don't have to worry about kind of ups and downs of business cycles. But yeah, don't try to time anything. It's not going to work out.
Final question before we get to the potential Trump tariffs, just to hit on this quickly. The other new thing coming in December 15th is the first-time home buyers allowing to get the 30-year amortization if they put less than 20% down. Should first-time home buyers be pumped about that? I know it's more more interest over the life of the mortgage, but it gets you in, your payments a little bit lower. Should that be an exciting thing for first-time home buyers?
I think so. I mean, you're already gonna have to be kind of on the margin of qualifying anyway.
Right.
It gives you about 10 more purchasing power. So if you're in the market and you can't qualify at 25 years, you can't qualify at 30, then this is going to help you out. I don't think most people that are in that situation are really perhaps thinking like about how much interest they're going to pay long. Like I don't think those are the real that's not like I don't think most people are doing that kind of long-term financial math. And like, it's funny, like most of the young people I talk to that have mortgages, it's a totally different mindset. They have no plans on paying their mortgage over their lifetime. Like they're huge mortgages. They have no plans on you'll eventually sell it. And that's the plan like literally like everyone I talk to is like, I'm not paying my mortgage ever. So this idea like, oh, you might pay more interest over the okay.
Is that
much of a concern?
Is that statement more concerning though? That
yeah, a little bit, right? Like
yeah,
it's not what I would do. But
right.
It seems to be, at these mortgages. If you think financially, you have a very low rate. So if you have a $1 million mortgage or more, again, the people I'm talking to can afford these mortgages. You have a large amount of debt that you're servicing at a super low rate. Then I think most financial advisors or experts be like, yeah, like you've got better opportunities over your lifetime. Why are you paying off your mortgage if at a very low rate versus you could take that money that you would put the extra money and save it in something that's going to get more higher rate of return than what you're paying on your debt, and that's a better avenue. So
I guess
I
it
don't know.
worked out great when prices double every 10 years. When things
Right.
cool off for a bit,
That's the thing. That's likely, hopefully, not going to happen. It is kind of a bet though on like, is policy going to work? So soon over the last 25 years, home prices in BC have grown at 6% per year. So they double every 10 years.
Mm-hmm.
If you think that the provincial government's policies, the supply side policies are going to be enough to constrain or reduce that price growth significantly, then you're probably not going to get a lot of price appreciation over the next few years. But you're also then believing they can do that, and they have a pretty terrible track record. So is maybe the better bet is we're going to keep getting, once things normalize, I don't believe they're going to be able to build 600,000 more units over the next decade. And that means we're going to have significant price appreciation and you end up coming out ahead. And maybe that's the better bet.
Wait a minute. I thought we were building like 35 million new homes or something.
Trillion, billion, gazillion was the number, I think.
That's the
all right. Potential tariffs, 25% of all products coming from Canada. 77% of Canadian exports go to the U.S. I believe trade is roughly 60% of Canada's GDP, and just with the states might be whatever. Okay, so yeah, please correct me, by the way.
I think it's about 30% of GDP, but say 70% to the United States. 54% BC. We have less exposure in BC to the U.S. than the rest of Canada.
Does a 25% tariff, if this actually happens, this could really, Steve, jump in before I ask the expert. Okay.
I just want to take my bet on it doesn't happen, but okay, keep going.
Okay.
Go ahead.
Let's say it does happen. This is bad, right?
Yeah, of course. It's terrible.
Yeah.
So going to start at first principles, what is a tariff? So if the United States puts a tariff on all incoming imports from Canada, that means our exports get more expensive. So in this case, if they put a 25% tariff, that means all Canadian imports to Canada get 25% more expensive. Causes inflation in the United States in two ways. One, it makes all imports more expensive, and sometimes pretty direct. Like most of gas produced in the Midwest of the United States comes from Canadian oil. That automatically gets more expensive. That means gas prices go up in the Midwest of the United States. It also, that's across all consumer goods. So it also directs demand away from imported goods and towards domestically produced industries. That increased demand then also puts upward pressure on those domestic goods, causes inflation. So you have your importing inflation with the tariff, and you're causing
Frozen.
You're frozen? Brendon, you still here?
If you need insurance, you need to go where I go, squareone.ca. At squareone.ca, you can get a quote done in just a matter of minutes. If you're a tenant, landlord, or a homeowner and you need a policy, go to squareone.ca, or better yet, go to squareone.ca/The Tom Storey Show and save $20. That's squareone.ca/The Tom Storey Show for your discount on home insurance right now.
Should we just go from that question again?
Let's just go from right here because we had an internet problem, and the people will understand.
All right. So I think I was saying that tariffs cause inflation in the tariff charging country in a couple of ways. One, it increases the price of all imports from Canada, and it also directs demand away from those more expensive imported goods towards domestically produced goods, and that's going to produce higher prices there. It also means inputs to production are more expensive, so we have globalized supply chains. So you think the auto industry has this constant back and forth of parts and between Windsor and Detroit. That means all those imported kind of components and everything else get more expensive. Those get passed on to consumers as well through generating inflation in the United States, and also reducing demand because things are more expensive. In Canada, it means that our exports fall considerably because now our largest trading partner is not buying as much of our stuff, and that massively hurts our economy. It could also there's a couple avenues for the price level in Canada from this. One is that it's the textbook theory is that because we can't export a lot of goods, we end up then having a surplus of stuff to sell in the domestic market, and that puts downward pressure on prices. So we'd have lower inflation. That's possible. It's also possible that because higher prices in the United States kind of leak through and a lower exchange rate causes some import inflation in Canada, we actually have slightly higher inflation. It's kind of hard to tell which one of those is would kind of win out. That has implications for the Bank of Canada. So in the situation where our economy is really we've lost 2% of our output is sort of the estimates I've seen at 10% tariff. Then the Bank of Canada might choose to respond by cutting rates because the economy is much weaker. Harder to do that if inflation's also rising, though there's some papers out there that argue that the Bank of Canada or central bank should look through tariff shocks and respond to the economy instead. So that's a situation where we have a tariff put on us and we don't retaliate. So in a situation where in retaliation we do something very stupid and put our own tariff on income in U.S. goods, this is sort of what always happens. We end up having a trade war. Then things are much worse. The impact of the economy is much worse because now we also have much higher priced imported goods for the United States. We have higher levels of inflation temporarily, at least, and a much weaker economy. And again, difficult to say whether the Bank of Canada would look through that tariff shock. So what it probably means for like mortgage rates in the situation where the Bank of Canada is deciding to raise rates, obviously variable rates would be higher. 5-year fixed rates might be higher either way because they tend to respond to global markets and to what's happening in the United States. So the 5-year bond yield might start really rising because of much higher expected inflation in the U.S. gets priced into that part of the yield curve. We have higher 5-year rates, higher 5-year fixed mortgage rates. Might even be a risk premium built in because there's more kind of perceived risk in the economy. So we could have a situation, there's sort of two avenues where maybe variable rates are falling because the Bank of Canada is cutting because they're responding to a weak economy instead of kind of looking past the tariff-driven inflation. Or we have a situation where we have both variable rates and 5-year fixed rates rising because of these tariffs at the same time that our economy is getting much weaker. That's sort of the worst case scenario. And so we put together a bunch of estimates based on a 10% tariff. I did them based on a 25% tariff and did not share them because they look really
scary.
It's just, and it's like, and I think like Steve is saying, I think, although we made this mistake all the time where it's like, he can't be serious. And then he's always serious. And it's not like it's not 40 chess. He's playing checkers and he's eating the pieces. Like, I just don't think he understands.
Well,
he understands any of this.
I think that's probably the truth of the matter, just because he's obviously at a spot now where Elon Musk is one of his biggest champions, and and apparently respects what he has to say. And Elon Musk is hard on obviously he's involved in manufacturing, first off. And he's like, you may be able to introduce tariffs, but you have to do it with a super long runway, or you don't understand how you're going to decimate your own manufacturing within your own country, because you will not be able to provide the products at the same cost. Therefore, tariffs are actually a very, very bad thing. So I think there's a lot of strong arming right now in order to position to make other things happen, right? Like, he wants to look like the good guy, shut down the borders, shut down the drugs, do all that stuff. So he's going to do a strong position, and then he's going to go, oh, they did stuff, so now I don't have to be as mean as I was going to be, right? That's probably a more likely scenario.
Yeah, especially the 25% tariff was somehow linked to apparently a massive flood of people across the northern border.
Yeah.
So anyway, I don't think we'll get a 25% tariff. I think it's still possible we have the 10% tariff that was originally floated, but who knows? I mean, this is, again, this is policy made by all caps rant, and I don't know how seriously do you take that?
I don't I don't see that as actually being a negative thing, cracking down on cross-border illegal like activity, right? Like crossing the border without the authorization of each country is illegal and it should be cracked down on. The fact that it's just okay now is nuts. Is this a solution? I don't think so.
Yeah, I'm not sure destroying the entire North American economy is the solution, but
Could
your
be.
mileage might.
Okay, I want to jump into now. We got, I don't know, maybe 15 minutes left, if that. What should we expect in housing? Maybe BC, maybe Canada. Where are we headed? Do you have any bold predictions? Do you dare make predictions for next year? What's the modeling telling us? Where are we headed next year?
Yeah, so we've only done again, because the worst thing you can do is put out a forecast based on like worst case scenarios. So our baseline is that we have a level of sales in BC that looks a lot like October, November. So kind of pretty close to the long run average, which is kind of where we thought we'd be. So that means, like 85,000 sales next year, with plentiful inventory. So, close to that, like 40 to 45,000 active listings number that we'd like to see. And that keeps prices pretty flat. So I think very boring. I think our forecast for last year for home prices was maybe up 1 or 2%. I think it's going to be up 1 or 2% next year because, that's a pretty decent baseline. I think we might have a stronger spring than we've had in a while because there's so much pent up demand. I could see things jumping a little bit more in the spring and then coming back to normal in the second half of the year. But lots of risk. All that forecast really depends on what happens with rates, and what happens with rates is a little up in the air. I mean, if a lot of the stuff that's being, I know you said day one 25% tariff. Assuming that doesn't happen, and maybe we do get some across the board tariff at some point, it probably isn't going to be until like end of 2025, 2026 maybe, and who knows? Maybe he'll get distracted by something else by then.
New home sales is a conversation that's coming up a lot, especially in my market. It's like scary. We're down like 91% in new home sales, and it won't be an issue next year because we got a ton of condos coming to downtown Toronto and surrounding areas. But then in a few years, we're not selling anything. This is a problem. One of the reasons why we believe it's happening, other than the obvious, which is interest rates and lots of inventory, and that these new homes cost a lot more than the resale options, is that, man, these municipalities just get as many fees as they possibly can. And that's one of the biggest factors that's making the numbers not work for the developers and the numbers not work for the buyers. Are you concerned about the new home sales numbers being down so bad that this could now not only be an issue now, but in the future, we're not building anything? What's going to happen?
Yeah. So a couple things. So one, data, and then two, going to rant for a couple minutes. So the first part, just looking at like in BC, the inventory of completed but unabsorbed, so unsold units, it's about the highest it's been since 2018. It's not like a 2010, 2012 levels where we had a massive post-financial crisis overhang. We were building a whole bunch of stuff, especially in like the Okanagan in BC, but also in Vancouver. And then demand completely dropped out of the market after the financial crisis. And we had a lot of inventory that took a very long time to sell. And that kept prices flat for like 8 years, which was kind of a nice side benefit. So I'm watching that closely. I know it's not quite at Toronto levels where apparently inventory is very, very high of unsold new homes, but it's certainly something to monitor. And it's kind of like the other day we talk about 45,000 active listings. We kind of have to like think about almost like a shadow inventory of like new homes too that's not factored into that. So it is much higher. Normally you can ignore it because the inventory of unsold homes is so low, it just didn't really matter. Now it's starting to get to levels where it actually makes a difference. So that's something we're keeping an eye on. So then the ranty part where I start to sound like this bookshelf back here is full of Ayn Rand or something, and I'm like a weird libertarian. I'm not, but I've been kind of radicalized by terrible government policy on this point anyway. We need to attract a lot of investment. So, Ontario wants to build a lot of homes over the next decade. The BC government wants to build 200 to 300,000 more units than we would have built otherwise. So between 500,000 and 600,000 units over the next 10 years. To do so, we need capital. So someone has to pay for 600,000 units, and that's either, if you build condos, you need to pre-sell them because of regulations, and you have to pre-sell like 70% of them to get financing. And we need investors to want to buy them, right? Or we would need corporations, so pension funds or REITs to want to build purpose-built rental. So we need people to invest in housing, somewhere between $200 and $300 billion, not including infrastructure, over the next decade. So that capital has to come from somewhere at a time when we've never made it less attractive to be an investor in homes. So since 2010, the list of things you can't do, and this is where I start to sound like a libertarian, things you can't do with your own property without incurring a penalty. You can't leave it empty. If you do so in Vancouver, you'll pay 3 taxes, so 3 different empty homes taxes. You can't sell it to a non-resident. That's the foreign buyer's tax. You can't use it for short-term rental, and if you use it for a long-term rental, it's really, really hard to get rid of a tenant, even if they're really difficult. You can't own your home without. You can't own your home while paying 51%, or sorry, you can't own your home while earning 51% of your income outside of Canada without paying a fee. That's part of the speculation and vacancy tax, besides being neither speculation nor vacancy. And you can't sell your home within 1 year. You'll pay the anti-flipping tax federally, and starting January 1st, you will pay both. In BC, you'll pay both the anti-flipping tax federally and the provincial flipping tax.
Can I add one in? Last
Yeah.
time I visited Steve, he said that you couldn't have, maybe this is just a BC thing, you can't have automatic sprinklers on your lawn. There's just one dude with a hose just doing it himself. That's not a Toronto thing that I'm aware of. So you can't water your grass either.
I'm sure the list that's only a partial list. So I don't know if you're looking at investing in then getting to like we didn't even talk about they're gonna try and organize a pretty mass outflow of temporary foreign workers and national students over the next 2 years, and that obviously is going to mainly hit the rental market. So not only are all these things you can't do with your property if you want to be an investor, you're also probably going to get lower rents.
If you're a real estate agent in Ontario, you're well aware of what TRESA is and the new RICO information guide. And explaining that guide to your clients is of absolute importance and is mandatory. Now, we've been using an additional resource that we got from TRESAvideo.ca. It's been really helping our team have that conversation with potential buyers and potential sellers from the very beginning. Check out TRESAvideo.ca to learn more.
Well, at least from my point of view, and I've been vocal about this, where I'm not sure this is a good thing or a bad thing. For my market here, the only thing that is being built right now is purpose-built rentals. New condos aren't selling. We're not building houses. One-off people are building their custom houses. We're not building houses, right? We are building purpose-built rentals only. And in 5 years from now, all the new inventory, all the new housing will be housing that cannot be purchased, but it is owned by a big corporation, which I'm not even saying is necessarily a bad thing because they have the funds to actually build it. And then if you build all this purpose-built rentals, maybe that should theoretically push down rents anyways, but then if rents get pushed down, then these companies aren't going to keep building the new ones because the numbers don't add up. You can see I'm going in a circle here. Like, is that a valid concern that we're not building the actual housing that I know we need rental, but is 100% rental going to do the trick for us?
This is what we do. Like, we didn't build purpose-built rental for like 30 years, and now it's the only thing we're building.
Right.
But because the numbers on condos just aren't penciling, right? So maybe eventually it will. There's I think Haven, there's a local, is that a Vancouver? It's like a home builder organization. Anyway, they put out a study on DCC, so on development charges here, and in the CMA of Vancouver, I think in the township of Langley, if you want to build a single family home, it's $120,000 in development charges and other municipal fees just right up the jump. If you want to build an apartment in the township of Langley, it's like $50,000 a door. And
Crazy.
and it makes like North Van look good, but even in North Van, it's like $25,000 a door for an apartment. It's like it's just these are really high, and it's you have to pay for infrastructure somehow, and we've decided that new development should pay for itself essentially through fees. The only other option is much higher property taxes, which is a sure way of having your government get voted out, because people really hate paying property taxes. So it's a really tough situation. If we're going to build a lot of new housing, we got to pay for it. I don't know if we need to pay for it. If the development charges are sort of priced correctly. Seems not, because they vary so much from municipality to municipality. But I don't know. We got to figure out some way of paying for infrastructure in a way that doesn't totally distort the amount of supply we can bring to the market.
Steve, yeah.
Yeah, you mentioned possible outflow of foreign students, temporary workers. I'm not necessarily of mind that number will drop as much as we think it will drop, but
right, the first decline in the Canadian population, I think, in a century.
Well, I mean, I'm just not sure why they set a target if they got a blindfold on. You know what I mean? Like, it's not really a point. So let's talk about. So we got PRs that are new to the country working. That are usually, when I'm getting someone reach out, say through YouTube or something, they're usually like a brand new PR. They don't know anybody here. They're like, okay, I finally can buy. I'm ready to buy. They're pretty set. But driving around my neighborhoods, bus stops are absolutely jam-packed with what is obvious to me to be foreign students. I recently rented out my condo, and most of my applications came from government-funded asylum seekers. Most of them, actually, which was kind of scary. But all that stuff aside, let's say a foothold of those people that are probably in their young 20s, a lot of them, to maybe under 30. Let's say a lot of them actually end up staying. And we do compound them, but let's say we don't compound them. They're just here. If you have an influx of, let's say, 1 million or 1.5 million people that are 25 years old now, what does that say at 35 years old when they all have a child and they're maybe, hopefully, their feet under them and they can hop into the marketplace? Like, is this something where in 10 years, building doesn't get better and we have just pushed in this massive young population that could then just shoot prices back to the moon again? Is that something that is realistic, or are these announcements with all this, we're going to lower our targets on anything, actually going to help?
No, so that not the amount of population growth we've had over the past 2 years certainly hasn't. That's not projected to go on for the next 10 years. But we certainly, if we didn't have the level of immigration we have now, we'd have a declining population in BC because we have more deaths than births. We have a super low birth rate. It's one of the lowest, I think, in the Western world in BC. And so when you look at our population projections, they're almost entirely based on immigration. And then the way they break up demographically, I think fits what you're saying. So yeah, it's sort of like our demand over the next 10 years is supported both by people who are here now, aging into their home buying years, and working years, and then everyone, new people showing up. So it's kind of baked into all of the demographic projections already. Not the rate that we've seen over the past 2 years, but a lot of that was temporary or non-permanent residents that are kind of those fluctuate. But as far as like people who are going to stay here, like those are kind of baked into to demographic projections, and that will keep kind of the employment levels and sales levels and everything else kind of at where they should be, instead of having an economy that's shrinking because our population is falling.
I got 2 final questions here, and then we'll let you get on with your day where you get to answer more questions from people, I'm guessing. I feel like this whole episode is me and Steve just going like, we give an opinion and we're like, are we on to something? Can you confirm or deny what we're thinking? Okay.
But it's my favorite part of doing any speaking stuff is the Q&A. I'm always heartbroken when there's no questions.
There's no questions. Yeah. It just means you've done too good of a job explaining things, I guess.
It's not that, that's what I think.
That's what you tell yourself. Yeah. All right. We've made jokes when you've been on the program before about how the models are always right. Your models were pretty bang on the last year. is there anything that we haven't talked about that you are modeling right now that, like, you know, the average consumer, you know, the normies, as you put us, would need to think about or be aware of? Like, is unemployment an issue still? Like, what models should we know about that we don't know about?
And normie is a good thing, by the way. It's not a pejorative. Like, it's better to be a normie than not. No, like the things that we're really working on for the next year is sort of like, what is the impact of that if that net outflow of non-permanent residents happens? What's the impact on rental markets? Rental data in Canada is terrible, so it's kind of hard to get a hold of. But that's one thing we're trying to incorporate into models going forward. The other thing that keep me really busy is just policy announcement via all caps rants.
Yep.
Modeling that kind of stuff, because like it seems far afield from housing, but it really matters to monetary policy and to mortgage rates, which is why we're spending so much time on it, because it really would dictate the total direction of the housing market over the next couple of years. So those are the things that are really occupying my time. I don't have great answers on either yet, but those are certainly, you know, places where we're looking to get like some kind of like at least sketch out some like quantitative numbers for people. I think it's always nice, I think, for people to have like at least kind of a box containing like, here are the things that could happen. I think is usually useful. So that's what we're really spending a lot of our time on. And we'll see if we can, I'm sure a million things will change in the next 2 weeks. We'll have to keep
By the time this
revising or-
episode's out, something will change. And
Exactly. But I mean, I'm sort of like I've been saying, I'm kind of short-term optimistic. Like everything kind of points to the next few months being pretty good. We'll see where we go from there.
all right, my final question, then I'll let Steve wrap it up. Did the mortgage renewal cliff officially become a nothing burger, or was it real and we just got out of it because they allowed people to extend their terms back and, you know, all the things that they were doing?
I think that we just started talking about it too early. Like,
Yeah,
it wasn't
maybe.
to be an issue in 2024, because that wasn't really when people were having their fixed rates mortgages renewed. So if you took out at the absolute bottom, I think it's 2021, you could have had a 5-year fixed rate at like, was it under 2% or
I
something?
think some were under 2.
So you're not getting renewed till 2026
Mm.
in that situation. So I think that renewal cliff idea is more of a 2025, 26 story. We certainly had a bunch of it. Like a lot of people took out variable rate mortgages and even adjustable payment mortgages with a variable rate during the pandemic, and they got hammered over the last couple of years without any real spike in either like mortgage defaults or even new listings. Like we didn't even see people generally. I talk to realtors all around the province every month at the start of the month, and I kind of stopped asking them because it was on our mind. Like, hey, are you seeing a lot of any of your clients that are listing? They're listing because of they're concerned about their renewals, or they're on a variable and they can't make the payment, and it just was never an issue. And then I stopped asking. So we'll start circle back to it in 2025. But I think that's probably when like the bulk of those renewals are hitting. I think, at least if I remember the Bank of Canada's data correctly, is like 2025, 26.
Which, you know, we'll see what happens, but fixed rates will probably
Or more a wrinkle for the next
probably
years.
be in the 4 to 4.5 range, unless
It's not as right.
it's not 6 anymore.
Good point. Though maybe that's another reason why the Bank of Canada, although again, 5-year fixed rates are determined more by global factors, so there's not really much escaping it if we get into those sort of situations. Yeah.
All right, Steve, I've left the final most important question to you.
I don't have a question. I just want to kind of summarize. So if I get this right, what you're telling me is 2025 has the potential to be possibly one of the most boring years
Wouldn't that be
ever
great?
in Canadian real estate, or the craziest year of all time. So we've got one of those two things. That's good.
That's right. It's a wide confidence interval, right? I feel like it's like could be anything.
So yeah, that makes me. I mean, I would love a boring year. Honestly, I would absolutely love a boring year.
I haven't had one yet. I've been wanting one for. I thought my last time I said we were headed for a really boring year was the end of 2019, and got it. Right.
You know what? Maybe actually just don't say anything about next year yet.
I don't want to jinx it.
Yeah,
I don't
let's
wanna
just
jinx
get there
anything.
first.
We probably it's like talking during a no hitter. Like just we've already jinxed it.
This was great, man. Thank you for coming back on the show.
Anytime.
If there's people watching this that are not real estate agents, but they're just people in the market, can they get access to your reports publicly?
Yeah, I think everything is on our website, bcrea.bc.ca, and you can follow me on LinkedIn. I don't think I've ever denied. The only time I ever reject a LinkedIn request is if you immediately try and sell me something.
Yeah, that's like half the ones I get. I click accept to the request, and then there's like a populated message.
Well, be prepared for a bunch of those.
Awesome.
Yeah.
Well, we appreciate you taking the time to do this. I know our viewers definitely enjoyed it as well. We're crossing our fingers, but not saying anything that 2025 is maybe a little bit boring, or maybe crazy, or maybe somewhere.
You can't even. This is like, hey, is there a no hitter happening right now? Like you can't head that way.
I'm in a group chat with 5 guys, and there was a few things that were a Jays pitcher this year got to like the 9th inning twice. And this one guy would always say, turn on the game. And as soon as he'd send the text, the no-hitter was over. So
got to toss him from the group chat.
Yeah, exactly. All right. Thank you, everybody, for watching and listening. Have a great day, and we will see you soon. Bye.